All right, welcome back to The Explainer. So let's just get right to it. The crypto market looks like a bloodbath right now, right? A total sea of red. Prices are tanking, and you can practically feel the fear in the air. But here's the twist. Behind the scenes, a lot of analysts are actually, surprisingly, bullish. So what is the deal? Are we watching the bull run die? Or is this the buying opportunity we've been waiting for?
I mean, this is the question, isn't it? It's on everybody's mind. Look, seeing your portfolio nosedive is it's never fun. And it's totally natural to feel that knot in your stomach, that little voice screaming panic. But hold on, before you do anything, let's really break this down. Let's look at what's driving all this fear and then explore the other side, why some people are looking at this and thinking, you know what? This is actually a good thing, a necessary thing.
Okay, first things first. We can't just brush past the anxiety. The numbers are big and they look pretty scary. So let's get into the two main things that really sent the market into this freefall.
So the first big hit came from institutional selling. We're talking a massive scale here. In just one day, more than $800 million was pulled out of Bitcoin ETFs. I mean, think about that. We saw funds from major players like ARK Invest and Fidelity hit with record outflows. Even BlackRock's IBIT, the big one, it took a rare hit. It was a crystal clear signal. The big money, the institutions, they were cashing out and taking profits.
And if that wasn't enough, that selling pressure got a huge unhealthy boost from this, almost $1 billion in liquidations. Now, if you're not familiar, that's basically when people who've borrowed money to invest, using leverage, get their positions wiped out as prices drop. They're forced to sell. It's like a domino effect, just one thing knocking over the next, pushing prices down faster and faster. And some analysts think the real number of liquidations was actually even higher. Ouch.
Okay, so that's the bad news. That's the stuff that makes you want to turn off your computer. But this is where the story takes a turn. Because if you look at this from a purely technical angle, a lot of analysts are saying this drop wasn't just predictable, it was necessary. They're actually calling it a healthy reset.
And to get why they're saying that, we just need a quick look at this tool called the RSI, or Relative Strength Index. Think of it like a speedometer for the market's momentum. If it gets too high, it means the asset is overbought, it's gone too far, too fast, and is probably due for a drop. If it gets too low, it's oversold and might be about to bounce back. And here you can see that reset in plain sight. So before this big drop, Bitcoin had just gone on this massive 25% tear, and its RSI was way up there in the high 70s. That is classic overbought territory. Red flag. But then, boom, the drop brought the RSI all the way down to 41. That is a total flush out of all that overheated momentum. It's gone from a pretty dangerous level to a much, much healthier neutral spot. It's getting a lot closer to what analysts would call oversold.
So who cares, right? Why does this RSI reset actually matter? Well, as the channel My Financial Friend points out, history might give us a pretty juicy clue. The last time Bitcoin had a reset this dramatic, what happened next? It shot up 25% in just 20 days. Now that's not a guarantee, but it is interesting.
All right, so the technicals are looking healthier, but that's just one piece of the puzzle. The bull case actually goes way deeper. If you zoom out from the daily charts, there's been a ton of positive stuff happening behind the scenes, totally unrelated to these wild price swings.
And this is a huge one. For years, maybe the biggest cloud hanging over crypto has been regulatory uncertainty, right? The SEC and CFTC fighting. Well, now the two biggest U.S. regulators are actually working together on something called Project Crypto. Analysts are looking at this and seeing a major tailwind instead of a headwind. It's a signal that clear, sensible rules might finally be on the way, and that could unlock a whole new wave of innovation.
And if we look a little further down the road, analysts are pointing to a really packed schedule of potential good news. Like this fall, we could finally get approval for crypto index ETFs. Think about that. Instead of just buying Bitcoin, you could buy one fund that holds a whole basket of different cryptos, like Cardano. Super simple diversification. And speaking of Cardano, on the tech side, they're rolling out some major upgrades, from new stablecoin programs, tokens pegged to the US dollar, to this huge privacy project called Midnight.
And you really need to hear this quote from Cardano's founder, Charles Hoskinson, to get how big a deal this Midnight launch could be. He says, Midnight is where we actually get to solve the hardest problems in the history of our industry, which is privacy at scale. So we're not just talking about another little feature here. The goal is to crack one of the biggest, toughest nuts in all of crypto, privacy that actually works for everyone.
Okay, so we've got a technical reset. Check. We've got some strong positive news in the background. Check. But there's a third, really powerful argument that analysts keep coming back to. And this one has nothing to do with crypto charts. It has everything to do with the bigger economic picture.
This whole macro argument really got a shot of adrenaline from the recent U.S. jobs report. Get this. The first numbers for May and June, they got revised down by more than 250,000 jobs. And then the July number came in way lower than anyone expected. For a lot of market watchers, this kind of thing creates some serious doubts about how strong the economy really is. And that skepticism, it feeds directly into the pro-crypto argument.
And that skepticism gets summed up, well, pretty bluntly, in this quote from analyst Michael Guyett, which was highlighted by the channel Crypto Tips. He just says, basically, job market strength is BS. The takeaway from this side of the argument is simple. The official numbers just don't match the reality people are actually experiencing.
Okay, but how does a weak jobs report connect to Bitcoin? Well, here's the logic that analysts are laying out, step by step. First, you've got government policies, like tariffs, which they say will lead to higher inflation. Second, a shaky job market puts pressure on the government to, well, print more money to prop things up. Third, all that new money flooding the system makes the dollars in your pocket worth less. And that leads to step 4. When your currency is being devalued, you start looking for a safe place to put your money, something scarce, something that can't be printed, something like Bitcoin.
All right, so let's just pause and take a breath. We've seen the absolute panic-inducing drop on one hand. But on the other, we've walked through the technical, the fundamental, and the big-picture economic arguments for why so many people are still so bullish. How in the world do you put those two things together? How do you reconcile those signals? Well, the way analysts are doing it really boils down to this 3-step story. First, you get the short-term shock. It's real. It's driven by fear, by liquidations, by those massive ETF outflows. Second, that shock acts like a pressure release valve. It triggers that healthy technical reset we talked about. And third, the big one, the long-term trends, the fundamentals like regulatory progress and the macroeconomic picture, those are all still pointing up. They're just operating on a completely different timeline from the day-to-day price swings. And that brings us full circle, right back to the core question of this explainer. From the analyst's point of view, when you piece it all together, this looks less like a 5-alarm fire and more like a fire sale. So the final question is really for you. Is what we're seeing in the market a warming sign, or is it a discount? Thanks for joining us on The Explainer.